So you guys have heard me say many times that I don't use technical indicators. I don't have a lot of technical indicators on my charts. I don't use moving averages and MACD and RSI and all of that stuff because I find that stuff rather pointless. It doesn't work. It's never been proven to work. Markets are random. You can't predict where the market is going, especially in the short term. You can't predict anything on a short-term time frame where the next candle is going to be as far as the next minute, the next hour, the next day, the next week. Now, if you get into multiple years, you can predict some things, especially the overall market we know is going to go up consistently over a number of years. But in the short term, especially on individual stocks, you can't really predict anything. So I don't bother with technical indicators. Now, some of you guys have asked me that it's impossible. You must use technical indicators. How could you trade without using technical indicators? And I just say, well, I sell options. And when I'm selling options, mainly I'm just worried about IV. I'm worried about whether the IVX is high, whether the IV rank is high. And then naturally, the next comment from those folks is, well, isn't IV a technical indicator? If you're basing all your trades around IV, you're using a technical indicator. You're using IV. And you're partly right. IV is a technical indicator, but it is a different kind of technical indicator. All your other technical indicators that you would talk about, like moving averages and Bollinger Bands and, parabolic SAR, MACD and RSI and stochastics and all of that stuff is all based around the price and the volume on the underlying stock. And pretty much 100% of your technical indicators, they're using some kind of formula based on stock price and volume. And it's all trying to predict where the market is going as far as price prediction. IV is very different. IV is just the implied volatility of the underlying stock. It's just how volatile is that stock based on some of the pricing in the past, right? That's all that is. So it's not based on price prediction. It's based on, hey, this is how volatile this stock currently is. And it's different with volatility. Volatility and price are very different because volatility is mean reverting. What does that mean? It means there's a average volatility that the market wants to go to. So if VIX, for example, is 30, that's quite high, right? That means we're trading in a much higher volatility environment than we're used to, and it will eventually go down to its mean, its average, somewhere around a VIX of 18, for example. Now, if VIX was low, say we had a VIX of 11, that's a very low VIX, right? And at some point, that VIX has to go up. There has to be a little bit more volatility in the market because right now, in that really low IV environment, now that's much lower than our historical average. So it's important to realize this. IV is mean reverting. There is a spot that it wants to be at, like the median, the mean, the average. It wants to be in that spot. So if it's really high, it's going to come down. If it's really low, it's eventually going to come back up. So that is volatility. Price, though, on the other hand, price is not mean reverting. And you need to understand this. There is no price that a certain stock wants to be trading at, meaning, hey, if it's lower than this, it has to go up to that price, or if it's higher than this, it has to come back down. That's not the way price works. That's not the way the market works. There is no price mean reversion. There are many examples of things that just go up. The SPY, for example, right? The overall market, the S&P 500, so something like SPY or the NASDAQ 100, the QQQ, they go up historically. There's no average, there's no mean that it's trying to get to. It just creeps up year after year after year. I mean, I'll have just some down years, but on average, they go up. There are many examples of stocks that they start going down and they never come back up. Maybe the industry they're in is a dying industry. Think of car manufacturers right now, things like GM and Ford especially, right? That thing used to trade much higher than it is now. What about the pharmacies like Walgreens? That industry is kind of a dying industry right now. The retailers, many retailers are going bankrupt. There is no price reversion, right? There's no mean, there's no average price that something, for example, like, I don't know, Macy's. needs to trade at, right? It can go all the way to zero. And trust me, it probably will one day, because many retailers in that same space have gone all the way to zero, meaning they've gone bankrupt. So this is a very important concept I want to hammer home. If you're new to options trading, volatility is mean reverting. You can make some assumptions based on the volatility of a stock or an ETF. Price is not mean reverting. You cannot really predict anything about price. Price is essentially random. And in the world of options trading, you always want to control the things you can control. I can't control where an underlying stock or ETF, where it's going to go as far as price. I can't control that. I can't predict that. It's impossible to predict that. If anybody could, they'd be a bajillionaire, right? They'd be a trillionaire, right? They own everything. If one person had the slightest little edge in being able to predict the market, they literally would own the world. Nobody owns the world. Nobody has that edge, right? So you really, I can't predict the market. I can't control that. What I can control, though, is if I know something has really high IV, now is the time to sell options, because that IV will come down and those short options will profit, because volatility, it's a fact. It mean reverts, meaning at some point that high IV has to come down. Now, when I sell my put or sell my strangle, it doesn't mean that, whatever time frame I sold, let's say I sell a strangle that's 60 DTE. I know that high IV has to come down. I don't know if it'll come down in that 60-day time frame, so it's not guaranteed that I'm going to win on the trade. But I stand a much better chance by selling that strangle if IV is high, rather than if IV is low or IV is kind of middling. Then, I'm much less likely to win on that trade. So that's how we use IV. And yes, IV is a technical indicator if you want to view it that way, but it's not like every other technical indicator, because it's not based on trying to predict price. Now, if you want to learn more about options trading, check out my book, The Super Wheel Option Strategy. This is about my favorite option strategy, which is the wheel option strategy. You'll find a link to the book in the description below. Peace, guys.